watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Mutooni from Sanlam Investments, Shane Watkins from All Weather Capital. Be sure to send those questions through email, stockwatch@bdtv.co.za, SMS 41392, Twitter Business Day TV using hashtag Stockwatch. Gents, appreciate the time this evening. Shane, let's start with you. A question coming through, and it's much more sort of a big picture. Talking around tariffs, we've got, a little under 4 weeks before the 90-day pause is over. Markets are at high. The question is, surely we're kind of getting ahead of ourselves when we simply don't know what's going to roll out around tariffs in July.
So, Simon, a very funny phrase was coined in the last week, which kind of mirrors the MAGA hat, which is not MAGA, but TACO, which is Trump always caves in, and or chickens out, rather. And I think most people are expecting that he will be forced to do some kind of deal. He said last night that they are very close to a deal with the Chinese.
Yeah.
That is one of their largest trading partners. They've done a deal with the UK of sorts already. And I think the market expectation obviously is that, the market's telling you that these tariffs are not going to be a significant factor. I think a bigger factor at the moment is perhaps that the market recognizes, if you look at the inflation numbers that came out of the States yesterday, which were around 2%, the market recognizes that perhaps the next move in interest rates in the United States is down, and that will drive global interest rates down. And I would say that probably is one of the factors driving the positive sentiment at the moment. But, the markets are not priced for any mistakes. Trump has also said that if they don't do a deal with Iran by Sunday, then, sort of military options are back on the table. Goldman Sachs says that if there was an all-out attack on Iran, the oil price could rally from sort of $70 up as high as $120.
Wow.
That would take US inflation by itself from 2% to 5%. So, you've got to say markets are kind of priced for perfection and not really factoring in any significant risks.
Roy, and it's also, maybe we end up with the 10% tariffs, which is kind of what everyone expected we were going to see on Liberation Day. We got a whole lot more. We got that dialed back. I don't know, can we kind of live with 10%?
It seems that way. Look, at 10%, you're still as high as you've ever been.
Yeah.
That's for sure. But remember, what he really needs is some way of replacing the lost tax revenue. And that's what he tried to do from the beginning. These tariffs are supposed to replace the taxes him and his buddies pay. And that's already going through the big, beautiful bill. So what's probably going to happen is they'll keep talking, and then they'll have some unilateral tariffs on people who can't fight back. That helps to pay for this, and then life goes on. It's just as simple as that. I don't think the big punitive tariffs will survive in any way, shape, or form. But for sure, there's got to be an increase in tariff income to support his big, beautiful bill.
Yeah, those tax cuts need to be paid for, absolutely. Let's go to some of the questions coming through. A couple on Karoo, why is the stock under pressure, etc. Roy, we're seeing Zach Callisto, the CEO, selling some $75 million of shares. There was actually a question earlier in the inbox saying, is Karoo looking attractive? Well, now it's 16% more attractive. Your thought on the sale by Zach Callisto? And I got to say, he can sell some shares, and I think the way he's doing it's perhaps not bad. And the valuation of Karoo itself.
So the first thing is it's highly illiquid. He owned close to 60-70% by the last time I checked. So it's one of those software as a service stocks that people really like. A lot of its business is in SA, but its listing in the US has really driven that valuation. So what he's basically done is he's let the valuation run on the back of this liquidity premium, and then he's dripped in a few shares. So this time, this has been a really big placing that he's made, and that's why I think the price went down, because the price came in at a discount, and then after that, the market price came down as well. So I think he's addressing a complaint that the market has always had, that there's many people who want these shares, there's no liquidity, there's no tradability, it doesn't reflect value. The truth is, when you look at valuation, you should also look at Altron and Netstar and the others in South Africa, because it's the same market effectively. It's still basically a South African business. And these guys are trading at a massive, massive premium to them. I would rather go out and get myself some Altron than go pay that 25, 26 times multiple that you're getting in the US for whatever hype there is there as well.
Yeah, I take a point. We have got others we can look at. Shane, your thoughts on CEOs doing some sales and Karoo more particularly?
So, Simon, the academic research shows that you shouldn't read too much into CEOs selling, but there is some statistical insights you can have from CEOs buying.
Yeah.
What I mean by that is people often sell just because they want liquidity for something else, where if they buy, they're choosing actively that specific thing. And so I would say if you said to me someone is buying shares in the company or the company is doing a buyback, I would say that that has got more kind of read through than selling. Having said that, I completely agree with Roy. I mean, I think Karoo, I'm guessing it's on about a 30 PE or thereabouts. It's a function of the free float, which makes, kind of takes sellers out of the market. And I think it looks extremely expensive. I mean, they moved the share just to the NASDAQ for the purposes of getting a higher rating, which is a legitimate thing to do.
Sure.
But then at the same time, the free float is restricted. So you don't have very good price discovery. I think we'd have a better idea what the company was really worth if it was a significantly bigger free float.
Yeah, I take your point. Look, it's worked, and I made the move to the Nasdaq, and we can't begrudge them that. That's what they're looking to do. Shane, next day with you. Question coming through: Growthpoint or Vukile? Very different REITs in many senses. Growthpoint, the giant one on our market. Would you have a preference between the two, or perhaps both or neither?
So both businesses have South African operations, and then Growthpoint have a big operation in Australia, and Vukile have a big operation in Spain. I think they're both very well-run businesses. I think Lawrence Rapp at Vukile is he's talented both on the operational side and on the financing side. And property is always a question of what is the quality of the underlying assets, and then how expensively or how cheaply are those assets financed. I would say that, Growthpoint's a much bigger business. It's the largest property REIT. I'd guess the market cap is sort of 40, 50 billion. Vukile is a much smaller company. Vukile probably has greater growth potential, but Growthpoint, I guess, is more of a steady ship. It's your kind of safer place to be. But I would say this, property shares are highly geared to interest rates. And I'm talking about not the short end of the curve, the long end of the curve. And all of the research that we've done shows that if you want to say what is a property company worth, it's very simple. You take the 10-year bond yield and you say minus a third of whatever the growth rate is of that company. So let's just say the 10-year bond is at 10% and the company is expected to grow at 15%, which would be a lot. 10 minus a third of 15, 10 minus 5 is 5. That share should trade on a 5% yield. So if you want to work out what a property share should trade at, take the bond yield and then minus a third of whatever you think the future growth rate is.
Okay, I like that. I'm going to go do that when I get home and look at some stocks. Roy, your take, Growthpoint versus Vukile. I mean, they are different, and maybe it boils down to what you're looking for, what you're trying to achieve.
So I'll say two things. On the narrative side, clearly Vukile has very good retail outlets in retail malls that are in rural areas, next to taxi ranks and all that. So they get really good footprint there, and they've done very well from that. The Spanish acquisition, they've also done quite well on it as well. Whereas Growthpoint, on the other hand, has had quite a sequence of poor execution on some of its acquisitions and operations. Australia's been an issue for them. So when you put it all together, I would say it comes down to valuation. On a yield basis, Vukile is probably on something like a 7 or 8% yield. Growthpoint is probably about an 8% yield. Remember, the bond yield right now is just over 10%, give or take. So it's about the growth that you ascribe to both of them. I would say they're both probably fairly valued. Vukile probably has better growth prospects and less operational issues around it, whereas Growthpoint still has the issue around office buildings, which have high vacancies, and there's no alternative use for. So at this point, I think I would probably look more towards Vukile because I think it's got better growth. But like I said, their yields and their forward yields are probably much of a muchness.
Yeah, I agreed on that 100%. Roy, let's stay with you. Purple Group, and let's put the disclaimer out there. Sanlam owns 30% of Easy Equities. Have you got thoughts on Purple Group? I mean, the question on the email is, they got 1 million active accounts. That must be worth something.
This is one of those meme stocks, and I mean that with the greatest respect to the proprietors. I mean, with Easy Equities, they've reached out, they've brought investing to a whole world of people who never imagined that there would be. But it's very difficult to pinpoint the value of those accounts. Remember, these guys invest in fractional shares. There's the whole thing about the fees and the revenue generation model. I think it's still early. There's a core group of people who really want to buy these shares and who really want it to rally, but I'm not entirely convinced about the current valuation right now. Liquidity is also an issue. So I would say this is one I would be on the sidelines with.
Yeah, it's that Thrive, which I think came in late 2023, which caused a massive uproar. Shane, have you got any deep insights into Purple Group?
Simon, the market cap is under 2 billion.
Yeah.
And we tend to avoid small cap companies. I think what I've learned over 30 years the hard way is that small companies tend to offer you a higher degree of operating risk and a higher degree of financial risk and a lower level of tradability in the market. So if you get into it and things go wrong, it's not so easy to get out. If you buy ShopRite and ShopRite has a speed bump, or you decide you want to sell for some reason, within a couple of days, you've traded out even of a large position. If you buy a big position in Purple Group, you've got to accept that you're married to that. The share price has also gone from, I guess, 80 cents to about 140 in 12 months.
Yeah.
So you're certainly not buying at the bottom, but I don't have a view on the fundamentals of the company.
Yeah, I agree with liquidity, and that's partly it. The big stocks, smaller guys like me, we can be out in a minute, but the liquid ones, even for us, it's tougher. Shane, let's go to the miners. A bunch of questions. The one is PGMs. They've finally caught a light. Is it for real this time? And gold on the other side, which is, trading around 3,400 at this point, can it still go higher? I mean, this is the big trade on the JSE. I mean, it's like you're becoming a mining bourse again.
Simon, it's amazing. When I started out in the market in 1995, mining shares were about a third of the market, and we're heading back in that direction.
Yeah.
Gold and platinum, after the unbundling of Amplats, are going to be together about 20% of the SWIX. So they've become a significant part of the market. And, gold and platinum, you mentioned Anglo Plats or Valterra now, and you mentioned Anglo Gold. Anglo Gold's up 100% year to date. Sabanya's up 100% this year. So they've done very well. I think gold and platinum are different. They're very different, right? The gold market is 140 million ounces a year. The platinum market is 8 million ounces a year. Half of gold goes into jewelry, 70 million ounces. Only 2 million ounces of platinum go into jewelry. But gold is really an investment metal, and platinum is largely an industrial metal. The thing driving gold at the moment, and I think it's likely to continue, is the world. There's been a breakdown of trust in the world. In the first instance, the Americans and the Europeans have taken the Russian central bank dollar assets, which were sitting in dollars, and they're keeping them for the moment. So that has made belligerent countries, or countries that maybe have an antagonistic relationship with the West, like, let's say, China, Russia, maybe Saudi Arabia, perhaps even some South American countries think, should we keep our foreign reserves in dollars that can be confiscated? Where gold cannot be confiscated. You keep it in your own central bank vaults. And the other great thing about gold is it's not related to any currency or any economy or any country. It is completely independent of all of those factors. So I think this is a very good environment for gold at the moment. And I think, the uncertainties are not going away. If anything, Donald Trump has amplified those uncertainties by by breaking down traditional alliances in the Western world where the dollar has been the predominant currency. So I think the outlook for gold, there's a secular positive trend. Platinum, well, obviously it's been driven by EVs, but there's increasing demand for platinum jewelry. And the reason for that is that people are switching out of gold, which is $3,000 an ounce, into platinum, which is $1,000 an ounce. And before I get too carried away on platinum, I just want to give you one factoid. Goldman Sachs, I think is one of the best investment banks in the world, downgraded platinum today, and the platinum share price was up 2%. So, if Goldman Sachs can't get the platinum share price down, then who can?
Yeah. Okay, that's a nice indicator. Roy, gold, PGMs, it does feel, forget 1995, it almost feels like 1985.
No, absolutely. So gold's been the trade for the past 1 or 2 years.
Yeah.
It's gone from moving sideways at 1,200 to now 3,000 thereabouts. And it's exactly like Shane says, it's about currency debasement, lack of trust in fiat currencies, and central bank buying. So that's been a strong underpin. Then Platts went moved completely sideways until I think a couple of months ago when you had the World Platinum Council, when they had that power in London and started talking about deficits developing. And from there, it's just been boom all the way up. So I think it's a combination of, first of all, people not believing we're going into a recession, so a little bit of an underpin into auto production, a little bit into jewelry, although jewelry is not such a big component of demand there, and the fact as well that it is cheap relative to where it's been. And remember, there's no new supply that's coming on. The only people who have platinum are the Russians, Zimbabwe, and South Africa. So no new mines coming in, no new mines have come in a long time. So there is this perception that there is a shortfall, and manufacturers need to start accumulating accumulating stock. So that's lit a fire underneath them, and it will be interesting to see just how long that lasts. Clearly, for platinum, if we do go into a recession, that's a problem. Yeah. Gold, on the other side, will be your store of value in a problem such as that.
Okay, I like that. There's a nice distinction between them. Rolex, stay with you. Question coming through. Naspers and Process, strong trading updates yesterday. They're looking like they have run hard, but they're looking like they could still have value if they can grow at those levels. That was a good update, and my sense of it, that yes, maybe they're becoming more than just Tencent.
To be honest, I don't think so.
Okay.
I think there's some interesting things they're doing around Tencent, particularly in Process. But at the end of the day, for those, if you don't like Tencent, you should be nowhere near them. I think that's still the starting point. If you like Tencent, you look in and you see what else are they doing. So there's a lot of corporate stuff that they're doing there that might generate value. This whole food delivery is still, I think the jury's still out on whether that can be a successful business or not. But at the end of the day, so long as Tencent is growing, so long as there's strong demand for their platforms in China, these ones trade at a discount to their holding. At some stage, you'll see either an unbundling or some form of corporate action that returns value to shareholders. That's, to me, is the way I think about it. It's too difficult to pick a winner in food delivery and all of those other things on the sideline. I say, if you like Tencent, keep your holding in these stocks.
Shane, your take on the Naspers Process / Tencent?
No, Roy's absolutely right. Really, you've got to be positive on Tencent, and then you're getting, a nice stake in Meituan, which is food delivery in China, and a big South American food delivery business kind of for free. But your real call is on Tencent. Now, on that, Tencent is going to be driven really by, the rising tide or falling tide of all Chinese shares. And if indeed Donald Trump has done a deal with China and the tariff war between the United States and China is over, Chinese shares have lagged significantly. The S&P, I think, reached pretty much an all-time high last night. Chinese shares are still, very, very depressed. We can buy extremely good quality Chinese companies on just into the double-digit PEs. and they're all sitting on a ton of cash. And Chinese consumers in total are sitting on $20 trillion of savings.
Whoa.
They just don't want to spend. If the Chinese government can find a way of getting Chinese consumers to spend and to switch some of their money into the stock market, the Chinese stock market is going to explode. So I think we are bullish on the Chinese stock market. And I think we are probably also like Tencent, and I think the food delivery businesses in process, essentially you're getting for free. And they're probably pretty good businesses. I think food delivery ultimately is going to be kind of a winner-take-all business in whichever markets the various players operate. And I think once that happens, the margins will increase and they'll make a lot of money.
Yeah, it sort of shake out. I agree with that 100%. Question coming through around offshore. Lululemon, really thought I had a winner here, but ouch, it's been painful. Should I just take the pain and exit? Shane, is it one that you watch? I think it was results yesterday, day before. Market didn't like much.
So, of course, Lululemon is a little bit like the Nike story. They're a very large established player, and they import the majority of their product from the East.
Yeah.
So obviously sanctions were a huge issue for both companies. Nike fell this year from $80 to $55. It's recovered a little bit, but I think both of them will recover quickly. There'll be some bounce back if there's a complete resolution of the sanctions issue. But I think, the same thing that happened to Nike is happening to Lululemon, is that they're getting displaced a little bit by some newer players on the block. Yeah. And so, maybe neither company have actively reinvented themselves as much as what they should have. They're saying that in the apparel and footwear business, you need to reinvent the company every 5 years if you want to stay at the front of what you're doing. And I don't think either of those businesses have.
Yeah, and there's been price increases. I know folks are saying, they've become expensive, and then the competitors come in underneath. We need to go to stock picks, Roy, so let's go with yours. Premier, and those were nice, good-looking numbers.
Yeah, Premier is solid. I think when you look at, right now they're a one-trick pony, effectively, because they're mainly in bread, but they're the lowest cost producer in bread, but have a higher margin than their bigger competitors. They're developing a new bakery inland, which should give them a very good foothold here. And that's a management team that knows what it's about. They kept their costs down. Their earnings are growing in those double-digit percent per take. And sooner or later, they'll be ready to make some good, sizable acquisition. I don't think it's expensive yet. It has rallied since it listed. But this is that you buy and you hold and keep delivering.
And just at that point, your mic seems to have died, Roy, but that's fine. We get it, Premier Group, and I hadn't realized that it doubled in the last little bit. Shane, are you going with Pepco?
So Pepco is a company that was originally part of the Steinhoff Group. Pepco owned 5,000 stores in Central and Eastern Europe. They are very similar to the Pep stores in South Africa. They predominantly operate in Poland, and they operate under the Pepco brand, but they also own a business called Poundland and a business called Deals. Oh. They sold the Poundland business today. It's about 800 stores, largely in the UK, and that was loss-making. So the Pepco business itself makes about 450 million euros a year, and Poundland was losing 25 million euros. So they kind of managed to cut off that diseased limb today. They also have about 500 stores, a company called Deals, and they are either converting those stores to Pepco's or they're going to shut those, and they'll focus on the core Pepco business. It looks extremely cheap. Management are executing quite well. They did recent results, and they showed that the core operation sales were growing kind of around 9%. The gross margin was in the high 40s. And Morgan Stanley put out a note, and they said, their opinion, over the next 2 years, the share price could double.
Okay, and in a nice twist of irony, Poundland was sold for £1, which kind of fits to a degree. That's all for Stockwatch today. Thanks to our guests, Mutooni from Sanlam Investments, going with Premier Group, Shane Watkins from All Weather Capital, going with Pepco. Up next, The Close. Stay watching.